Hello, welcome back, guys. So, Adobe reported earnings and it's actually down right now about 1.5%. It used to be down a little bit more actually earlier today. But right now, 1.5% down. We're going to examine what happened in the earnings report. So, if we take a look at this article here, Adobe shares move lower after full year projections fall short. As other companies have announced, I think Microsoft was the last one. Adobe pointed to foreign exchange rates when it announced its latest forecast. The company announced a higher price for some of its products here, some subscriptions. Now you will see that they fell as much as 5% at some point. Right now, much less than that. Earnings that they announced 3.35 per share versus 3.31 that was expected. So they have actually done better here and also done better in revenue as well. So you will see here that even though they have done pretty well in terms of earnings and revenue, they have lowered their guidance, and that generally speaking affects the market a lot because it's about the future. And you will see that it called for 1350 in adjusted earnings percent here on 17.65 billion in revenue, and the expected one was 13.66 on 17.85 billion in revenue. So that's some important reduction here in terms of the full fiscal year guidance here. And of course, the company pointed to the war in Ukraine, pretty much what has happened here with foreign exchanges. As I mentioned earlier, Microsoft and Salesforce also cited the same reason, basically, for these kinds of sort of like losses. And the economic environment, of course, that is uncertain in this period, that makes a ton of sense, understandably. And of course, the article also talks about some of the increases in terms of the prices of some of the products that Adobe is actually selling to people, especially subscriptions. Okay, so let's take a little bit of a look now at what Adobe is currently trading at and whether it's a nice opportunity, because it has been going down a lot from $700 pretty much going down to 357, so basically half of what it used to be, almost 50% down. And this downwards price action has prompted the PE ratio and price to free cash flow ratio to go down substantially from what they used to be, as you'll see here in these charts. Yet they are still relatively elevated, 35 and 25. Now, that doesn't mean that this company is not a buy, of course. We need to examine the finer details, which we're going to do later in the video, of course. So, what's up next for the company here? Of course, I think that you like to see a lot of outstanding shares that are going down instead of going up, meaning that the company is buying back shares, and total liabilities that are very little compared to the free cash flow that the company generates. That's something that I also like a lot because it means that the company is very solvent, doesn't have a lot of debt. 5-year revenue growth, net income growth, free cash flow growth, and total equity all increasing here and very nicely as well. So great growth for the company, pointing to it being a very nice opportunity in terms of its financials. But we need to examine whether it's actually cheap enough to buy as well. Now, you will see here that the debt to equity, again, kind of coincides with this one, the total liabilities to free cash flow, because it's very low, 0.3 debt, meaning debt to equity, meaning that for every $1 of equity, the company has $0.3 of debt. This is absolutely fine. And take a look at this return on equity here and the net income margins. The company is making great margins. Of course, it's a software company that makes a ton of sense. And also the return on equity is overall very nice without the company utilizing tons of debt, as you can already see in the total liabilities here compared to the free cash flow and the debt to equity ratio as well. So that's very encouraging sign, a very encouraging sign from the company. Seems to be doing rather well in terms of its financials. So the company is not paying any dividends, so let's take a little bit of a look at the actual financials, the actual income statements here and verbatim, and see what's going on with the company. From 7.3 billion to 15.8 here, very nice increase in terms of the revenue of the company, almost growing 23 to 24% every year, pretty much every year apart from this one. That's another great sign to see here. You can kind of predict what the company could be doing in the next few years. And in terms of the net income, 1.6 to 4.8, because 20% adds up every year pretty much, at least in terms of the revenue, if the net income is actually at a similar pace. And it looks like it is overall at a pretty similar pace, if not better really, as you can see in the growths here. Very nice to see. And the balance sheet over here, you will see that what I wanted to examine here, the total liabilities of the company, are sitting at 12.5 billion over here, and the total equity is increasing from 8.4 to 14.8 over here, with the company pretty much buying back shares. Remember that the company has been buying back shares quite some of those. And so they are not making this equity from stockholders, but their operations, and this is what you want as a shareholder. Now, total liabilities of 12.5 billion we are going to kind of examine in comparison to the free cash flow that the company generated, 6.8. So it's actually less than 2 years of free cash flow, of last year's free cash flow, to pay back all the total liabilities that the company has, which is absolutely amazing. And the free cash flow has been growing nicely as well. 2.7 to 6.8 is not bad at all, and seems to be getting better every year. Now, the net income here is producing from 4.8 billion to 7.23 billion in terms of operating activities because of some depreciation, amortization added back, and the usual stock-based compensation that is kind of plaguing the tech companies, especially the Bay Area companies. Now, cash from investing, for the most part, you will see some acquisitions over here, a little bit of capital expenditures, not much really. Look, this company is mostly about software, so their expenses shouldn't be too many, and I like that, of course. And as you'll see here, the cash at the end of the period is also growing for the company overall from what it used to be in the previous years. So very, very nice things about the company, yet we need to examine whether it actually makes sense to buy right now, because obviously the company is doing great. All its financials are pretty much in the green, as you'll see here. Tremendous, looking great. But is it cheap enough is the question that we need to answer. It has dropped a lot, 50%, but it may still not be cheap enough. That's what we're going to examine. Of course, we're not going to go with 20% for a revenue growth. That would be tremendous, but I'll have some concerns about it happening year after year for the next 5 years. So I will go lower. I will go, let's just say 12, 14, and 16 here, which is still pretty substantial. And net income margin, again, look at this, the same every year, pretty much, more or less. So we absolutely love to see that as a shareholder, because you can predict what's going to happen much, much easily compared to a company that is going up and down quite a lot. Same thing with the free cash flow. Take a look at this. It's almost the same, or at least very similar every year, nearing 140, 130. So we're going to go, let's just say 120, 130, 140 here. This is what the company has been doing pretty much. And annual return of 13% is what I typically like to be making out of my stocks. You need to be making more than 10% because you can just buy an ETF and make that like an S&P 500 one. So you need to be making more out of a single stock, more risky. If we hit calculate, let's see what we're getting here. We are almost there, it looks like. Our high estimates are the ones that are actually already there, pretty much, the 16% revenue growth, which is fair. It can easily happen. And all the other metrics make a ton of sense, really. Maybe the free cash flow margin could be a little bit elevated, but the company has achieved that, actually. So it may not be far-fetched at all. And I think that I would want to buy this one probably close to the medium estimates here. So if it drops near 300, I think this company could be a very, very interesting buy at that level, near 300 bucks. I think this would make for a very, very interesting buy. Of course, if it drops even more than that, that's even better. And it could happen because all these companies have been completely bust, completely annihilated lately. This one has gone down 50%, and of course it's in the tech sector as well. It's in the Nasdaq. So the Nasdaq has dropped significantly and has given us some very, very nice opportunities here. And I feel like Adobe is very, very close to becoming one of these pretty great opportunities. So I will be keeping an eye and probably actually update you with a new video when or if this goes down to maybe 300 bucks or 250. That would be even amazing, even more amazing. At 250, I'm definitely a buyer. So thank you for watching this video. Let me know what you think about Adobe. Are you an owner already, or are you thinking about it? It's actually enticing, to tell you the truth. It's getting there, I feel. And yeah, I'd love to hear your opinions about this. And please remember to leave a like and subscribe. And also, you can do all these things that I have done here with this tool, and then some, just by becoming a Patreon. And you can find links in the description box below this video if you're interested. In the meantime, take a look at this video that I made earlier, and I'm discussing what has happened today with Alibaba, which actually went up 10%, but later in the day actually kind of lost its track and started to give some of these gains back. But still, the news remain, and they're going to be affecting the company for the long run. So thanks for watching, and I'll see you soon. Bye-bye.